Hey everyone, how's it going? Welcome back to this quick educational video on power of compounding interest in trading. I really want to make this video for quite some time now, so today I finally got the chance to do so. I want to break down the benefits of compounding interest while keeping a good risk management in play. So the reason why compounding interest is so lucrative because you're reinvesting interest on top of the original interest, so you're growing exponentially in a way. The important note is that by having a strict risk management rule, proper trading plan, the account can grow over time. But why do traders often fail and why do traders often blow their account? So let's take a look deeper into this. So we know that by trading account, let's say in this example here, my risk management is always going to be 1% per risk per basically you're risking 1% of your total account on a particular trade. So let's say we start out with $1,000 trading account, which is pretty normal for a small size scale of a trader. You risk 1%, you're aiming for about 5% return. Okay, well, I'll go into a different scenario later, but let's say you do aim for a 5% kind of return per month, and this is kind of what you will get at the end of the year. You can certainly just Google and find out a compounding calculator where you can easily find out about the overall potential return per year base. So you can see that by risking 1%, which is $10 of $1,000 account by 1%, making 5% return is $50. So your reinvest is $50 into that $1,000 trading account. So now at the end of the month, you have $1,050 now, and your 5% is compounded in now because your 5% return is no longer calculated on $1,000, it's calculated on $1,000.50. So your next month return, instead of $50, which is 5%, now it's at $52.50, and you reinvest the 52.50 into the 1,050. Now you have $1,102.50, and so on and so. So every month, even though you're making the same 5% return, your interest, which is your return per month, you see it's gradually getting bigger and bigger because you reinvest into the overall trading size account, so your account will grow in time. Now, this is a very important concept because at the end of the year, you'll see that your total interest or total return is about $795, which means you're making about 79.59% return. That's annually, right, guys? So think about the compounding interest effect. Is that 5% for a $1,000 account for some people may seem very little, right? $50 maybe for a lot of you guys are very little, but you have to see it from a consistent, scalable point of view, right? Because at the end of the year, you're making very, very good return. Compare this to any of these index fund that you see, right? You're much, much higher if you can be consistent. But why do traders fail, and why do most of the traders, 90 to 95% traders, fail or blow their account several times? There's a really key concept in here is most of them do not understand or do not have a very good knowledge of risk management, trading psychology, and mindset in motion. Those are really, really going to tie into compounding interest very closely if you understand the key concept inside. Unfortunately, a lot of traders tend to overtrade, over leverage their account in the hope to double it in a shorter period of time. This almost always leads to them blowing an account, redeposit more money to revenge or chase back their losses, and the cycle continues, right? The truth is growing an account or count by compounding can eventually double account. Let's say in this example here, instead of making 5%, let's say you're making about 7.5% return per month while still risking 1%. Now you can see in this example here that by making 7.5% returns on your first month, you make about $75 off a $1,000 account. So your balance is $1,075 now. But because of compounding, your next month, your 7.5% is going to gradually get bigger and bigger and bigger. So if you look at this number here, by risking 5%, you're making about 795, let's just say $800, right? Let's just say round up the number here. Now, 7.5 is 2.5% more than 5%, right? So naturally, if you think regularly, well, another 2.5% of 5%, which is that 800 plus $400, so should make about $1,200, right? Well, if you look at here, the compounding calculator tells you that you're actually going to make a little bit more than $1,200. You're going to make about $1,381. That means the compounding here in your interest is slowly going to add up over time. Okay, so this is the important part is that if you notice here, by actually holding making 7.5% return per month, you actually successfully double your trading account from the original $1,000 to about $2,381. Okay, so that successfully make about 138.17% return per annually, still keeping 1% return and keeping a pretty mellow, pretty normal kind of return if you are very good at risk management. So why do this concept is so simple, but why do a lot of traders fail to do that? Well, again, it's because of that greed, emotion, and trading psychology, right? So you gotta understand that it's trading to grow your account by compounding your account can happen over time, but it's not something that's instantaneously or right away, which is what most traders think, right? They often will not only risk 1%. They're often going to have, let's say they have $1,000 account. Their goal right away is to double this, to make it into a bigger account right away in a short period of time. So they're throwing all the risk management out the window. They're basically just be like, well, I'm not gonna risk 1% per trade. I'm gonna risk 3%, 5% because what is it? $30 and $50 to a lot of people. Maybe that is not much to most of people, and $30, $50 is something that they're able to afford to risk, and they do not follow a proper risk management rule. Well, this is all not much harm on $1,000 account, but what if your account is a much bigger size now? Can you afford to risk more than 1%? Can you afford to see the money lose substantially in a dollar amount rather than a percentage amount on your trading account? And that's why it leads to people to start uh, over leverage, over trading. When they start seeing their account decreases, they're going to revenge the trade and trying to make back their money and only fall into a bigger hole. Okay, so take a step back and think about compounding interest in time and scale. Now, 5% return, 7.5% return may not seem much on $1,000 account, but you just have to understand scalable, right? You have to understand that what you're doing here by keeping risk at 1%, by making 5 to 7% return per month is not much, but is going to be sustainable and consistent by not over risking, over trading. In time, when the account is at a larger scale, a few percentage, even 5% or even 7.5% return per month, which is already very good, at least in my book, is going to create very good profitable on a larger trading account. So same example here. Remember, we're seeing 1%, 5% return per month, 1% risk, 7.5% risk per 7.5 return per month. Let's say the scenario now is changed. Now is that what if you're trading a larger account now? Look at this. We're risking 1% risk, we're making 5% return, but now my account is at $100,000 account. So look at the number here. Look at this number and compare to what we have seen before. You're making the same 1% risk, you're making the same 5% return per month, but because you're trading on a $100,000 account, your interest or your return is 5,000. Now 5,000 return back into the original $100,000 account. Now you have 105,000. And same thing, the second month you trade, you're making 5%. Instead of making 500, now you're making $5,250. So as you can see, over the year, nothing changes in terms of your risk management. You're still risking 1%, you're still making 5% return amount. It's that your account size is bigger now. So at the end of the year, you're still making 79.59% return. You're still making the same even if you were trading $1,000 account, but your return now, your balance is you're going to make a healthy profit of 79,500. You can see that the same example now that if we're trading and making 7.5% return per month on a $100,000 account, you literally just double your account in the same format, right? When you look at the same example before, you instead of making $1,381, you're making $138.177. Okay, so there's a big difference here when your account size is bigger, but is your risk management changed? Do you change your risk management? Not at all, right? Because we're still risking 1%. We're still trying to aim for a 7.5% return per month. So nothing changes here. It's all that changes that you're having a larger account now, but your trading plan, your risk management, your mindset, your emotion should not change because the return is there. Okay, so really think about in today's industry, there are many prop firms out there. Okay, do some research on the prop firms, what that means and what they can offer you. If you can be consistent and sustainable, understand that these firms are not looking for traders to double their account. They're looking for traders to make something like this or even 10% return. Something along this kind of range is something that they would prefer a trader to bid. They're not looking for traders to double their account. Why? Because they know by doubling an account, you sure are not only risking 1%. You simply cannot risk 1% and make 100% return in 1 or 2 months. It's just not feasible and not possible. And they don't want their actual live trading account, which is 100,000 or more, to be at a huge risk by over risking 5%, 10%. Remember the example below earlier, I talked about someone who will risk 5% or 10% per trade because of $1,000 is really not that much. Now that if you think about it, by risking 5% or 10% on a $100,000 account, that's 5,000 to 10,000 at a loss right away in one trade. And if you don't have proper risk management, proper trading plan, etc., you're just going to um, revenge trade that and eventually blow that account. And definitely the prop firms will not allow you to do that. That's why they have strict management rules and how much you can risk and how much is a cutoff and things like that. So do some research on that part if you're interested. All this is telling you that when you can prove that you can be consistent to compound a small account such as $1,000 account, there is no reason why you cannot trade a larger account by applying the same rules here. Because compound interest, this is a fact right here, right? Look at all the numbers here compared to the numbers when we have $1,000 account. Nothing changes except there's two more zeros. That's really all it is. Your risk management, your trading plan, your trading psychology, your mindset, your emotion, everything should be relatively the same. Doesn't matter now that you're trading $1,000 or if you're trading a $100,000 account. Compounding interest is going to work regardless because your risk is the same. The profit or the reward is the same. All it is that your profit is bigger now, but the risk is at bay. You're keeping it very strictly ruled to apply that. So the last note I really want to touch on is build up the right habit from the beginning. Okay, I think this is the really important part where a lot of traders fail or new traders or beginning traders cannot grasp is that your job as a trader is not right away make massive returns. Rather is to focus on risk management, control emotion, understand trading psychology. All these are once all of these are checked, then you will be miles ahead of other traders who are still struggling to understand this concept, right? Because compounding interest is going to happen if you can be consistent. Where most traders are fail to grasp is they are not consistent because they're not following a proper risk management rule. They're over risking, they're over trading, they're over leveraging their account because they're trying to double their account on a smaller account. But what does it matter if you double a small size account? Because at the end of the day, your return isn't that much, right? So by risking more, by putting your account at more risk, you're not generally making much more money on a small account. So why do people do that? Right? Your job is to be consistent first, right? Work on consistency, work on sustainability, because even with a 5% return, now that if you're trading a larger account, you're going to make very promising returns per year, and you're going to continuously compound your account in the years to come. Certainly, you're going to withdraw some money or on a monthly basis, whatever your life needs, but you're likely to continue to compound that account, right? Because now that next year, when you're looking at your trading account, you can certainly tell yourself, well, every return I make, maybe 50% of that I can withdraw and 50% I will reinvest into the trading account. So I'm still compounding my account, even though I'm not compounding to the full extreme potential, but I am still compounding my account. I'm also withdrawing accounts money or withdrawing profits so I can live comfortably, and you continue to do that for years to come. So really understand this concept, okay? So instead of trying to over risk and trying to make overly huge return but putting your account at risk, think about the simplicity of compounding interest, right? Think about making 5% or 10% within this range. I think it's all relatively fair and safe, so to speak, by always risking 1%. And you can see the result speak for itself, right? The result is there. The results speak for itself when you're looking at it from this point of view. Okay, so understand that there are prop firms out there where if you can prove a consistency to them, you can trade their larger accounts. So build up the right habit, everyone. Build up the right habit because it's going to help you to reach those goals easier instead of trying to think about, well, I have $1,000, I'm going to have to quadruple it in the next 3 months in order for me to gain some profit. Well, don't think that way, right? So there it is, guys. That is a quick discussion and educational content on power of compounding interest in trading, and as well as risk management and trading psychology. Any question, comments, or feedback, welcome to let me know, guys, and chat with you guys all next time. Thank you very much.